A modern middle-class family with two working parents is nearly 3 times more likely to file for bankruptcy than a family without children. We are going to break down the exact socioeconomic traps keeping wage earners financially vulnerable and look at the specific 4-phase blueprint the top 1% uses to build and protect wealth. This comparison chart reveals a strict divide in how households generate cash flow. Over 80% of all taxpayers operate on a labor-dependent model, drawing their income almost entirely from wages. Meanwhile, the top 1% pull the vast majority of their wealth from a capital-dependent framework, relying heavily on investment returns and pass-through business income. Relying on a single employer creates immense structural risk, but a bi-weekly direct deposit acts as a psychological anesthetic. Humans possess a strong behavioral bias known as loss aversion, where the emotional pain of losing money feels twice as severe as the pleasure of gaining it. As a result, workers reliably prioritize the short-term comfort of a guaranteed corporate salary over the perceived risk of building independent assets. This dependency pulls households directly into the middle-class trap. As household income rises, the baseline costs for necessities like housing, healthcare, and education rise even faster. Basic costs outpace wage growth, leaving families earning higher salaries but keeping less of their actual cash. In her extensive research on bankruptcy, financial scholar Elizabeth Warren identified an even deeper vulnerability, the two-income trap. When the modern standard required both parents to work, that extra income wasn't saved. Instead, dual-income households bid their combined salaries into the housing market, competing for homes in a shrinking number of high-performing public school districts. They locked their dual wages into high, inflexible fixed costs. Compare this to a typical single-income family in the 1970s. They possessed an unpriced structural safety net, a stay-at-home parent. If the primary earner lost their job or got sick, the other parent could enter the workforce to provide an emergency buffer. Today's dual-income household has twice the exposure to a sudden job loss, but zero unallocated labor to fall back on. Securing a higher salary without acquiring independent assets does not generate actual wealth. It simply constructs a highly leveraged, expensive lifestyle with no margin for error. The ultra-wealthy avoid this fragility entirely. Rather than relying on ordinary wages, they concentrate their earnings in capital gains, leveraging diversified assets to completely mitigate career risk. The structural foundations for this strategy are thousands of years old. A 4th-century text known as the Babylonian Talmud advised investors to divide their money into 3 equal parts: a third in land, a third in business, and a third kept in reserve. Today, that ancient rule of thirds has evolved. Investors use modern public equity and exchange markets to efficiently scale corporate ownership across thousands of companies. This chart details the modern investable portfolio for high net allocated to private alternatives for tax-sheltered cash flow. The final 12% is held in bonds and cash. Attempting to mimic this multiplicity by launching 5 different active side hustles usually leads to disaster. Splitting your attention across unrelated businesses causes severe cognitive overload and burnout, an operational trap investors call diversification. True income multiplicity requires focusing on a single area of deep expertise. You scale high-margin complementary products and passive investments that compound your existing knowledge, rather than draining your active working memory. Building those multiple income streams is ultimately useless if the resulting cash flow is decimated by ordinary income taxes. Protecting that capital requires specific legal frameworks. The operational foundation for this protection is the pass-through entity, specifically the limited liability company, or LLC. These structures allow revenue and expenses to flow directly to the owner's personal tax return. Wealthy investors heavily utilize LLCs to hold real estate, applying accelerated depreciation schedules to write off the cost of the property over time. This generates massive paper losses that legally offset the active income they earn elsewhere, lowering their overall effective tax rate. This illustrates the strategy of asset location. Tax-inefficient assets, like private credit or REITs generating high ordinary income, are placed inside the tax-deferred column. Conversely, high-growth investments, like low-turnover public equities, are kept in standard taxable brokerages, preserving preferential capital gains rates. If you don't utilize strict asset location, you risk converting low-tax capital appreciation into highly taxed ordinary income when you withdraw the funds in retirement. Untangling a household from the single income matrix requires precision. High net worth advisors typically execute this transition over a deliberate 12 to 18-month timeline. Phase 1 covers the first 30 days. The immediate priority is establishing a liquid emergency reserve equal to 12 months of fixed expenses. Simultaneously, you secure a $5 to $10 million personal umbrella insurance policy, a specialized liability cover to insulate your growing assets from lawsuits. Phase 2 happens within 90 days. You legally organize any active side income or real estate holdings into LLCs to quarantine personal liability. You also draft a revocable living trust, ensuring your estate avoids public probate court. By month 6, Phase 3 restructures the personal portfolio to mirror the high net worth model. Capital is systematically shifted into low-cost index funds, and you begin identifying passive yield opportunities in alternative markets like private credit. This flowchart demonstrates the advanced liquidity tactic deployed in Phase 4, implemented over months 12 to 18, the portfolio line of credit, or PLUC. When affluent individuals need cash for lifestyle expenses or real estate purchases, they don't sell their public stock. Selling triggers immediate capital gains tax. Instead, as the animation shows, they borrow cash against their appreciating equities at competitive rates, securing a tax-free liquidity buffer while the underlying stock continues to grow. True multi-generational security is never won by climbing the corporate ladder for a slightly larger salary. It is achieved by breaking the emotional addiction to the biweekly paycheck and aggressively building a diversified matrix of uncorrelated, tax-optimized assets.